Hey, good morning, everybody. Welcome into Mining Stock Daily. Trevor Hall here, your host, with your Friday long form episode. And it's an important one because it was a week of incredible volatility. The gold price held in there pretty strong. We're going to talk about that resiliency this week with Michael Howell from Crossborder Capital. And we're going to talk about where the liquidity goes. Did that yen unwinding of the yen carry trade decrease liquidity? His answer might be surprising to quite a few people, as a lot of his conversations are pretty surprising to me, at least. So it was important for me to get Michael on such an incredible week in financial history. Special thank you to Visa Silver, Arizona Sonoran Copper, and Fireweed Metals for the continued support of Mining Stock Daily. And as always, please leave a comment, like, subscribe, all those things on the podcast network or on the YouTube channel. It's going to be a great week next week, lots lined up, so do stay tuned for that. Enjoy this conversation, an important one with Michael Howell. Have a wonderful weekend, everybody. All right, everybody. What a week to be watching in financial markets. I kind of think in time, financial historians will look back at this early part of August 2024 as a time to remember. Lots of volatility, obviously. We've talked a lot, and there's been a lot of fingers pointing at that yen carry trade. So that we talk a lot about liquidity as well behind it. So why not bring in the king of liquidity from Crossborder Capital, Mr. Michael Howell, to kind of help us break down everything this week, this month, and maybe even this fall. So, Mike, pleasure to have you back on the podcast. Thanks for giving us your time.
Great pleasure, Trevor. Good to be here.
Yeah. Listen, if only there were a few things to talk about. You know, the big volatility, we had the VIX spike up to like 65, and that's only happened very few times. You know, obviously, 2022, 2008, and then this week, which was shocking. It's kind of shocking to think about. And a lot of the finger pointing this week and why there's such volatility was on, the media, the financial media was talking about, well, it's the unwinding of the yen carry trade. And anybody who didn't know what the yen carry trade was before probably certainly knows it by now. But I just can't come to grips and think like, well, that's the only reason that we've had such volatility. So maybe let's break this down. And I just like on the surface of things, Mike, I'd like to know kind of like how you were watching this kind of unfold, the spike in volatility, the sell-off in equities, the yen carry trade unwinding, the BOJ hiking rates a quarter of a point. How are you kind of breaking this all down here in the last week or two?
Okay, well, I think the first thing to say is that if you look at what drives asset markets, it really comes down to two things. Number one, and probably the most important of those, is the flow of liquidity into markets. Okay, has that been dented? Has that been affected by what's going on? I don't really think so. I think in many ways it actually may even reinforce what is a benign but currently quite shallow trend upwards. But I think that's, if you like, take away as a positive. The other is risk positioning of investors. So the flow of money is one thing, the risk positioning of investors is another. And what we've seen in the last week is a change in risk exposure. Risk exposure has clearly come down. It has been elevated. One could argue that given the backdrop in terms of the impetus of monetary ease and the pace of economic growth, maybe risk positioning got too much ahead of itself and it needed a bit of a pullback. That's probably not an unreasonable expectation. And we've got to remember, after all, this is August and we're always due some summer madness. So markets are thin, volatility is normally pretty high, policymakers are pretty absent generally, and investors are on vacation. So there's a lot of reasons why you could see this. But I think generally what I would say is that it's a risk event, a risk repositioning event. It's not any change in the underlying liquidity dynamics, which is really what markets are all about.
All right, so maybe let's talk about the liquidity dynamics. I mean, doesn't this unwinding of a carry trade have some implications on liquidity?
Yeah, I think it does, and I think you've got to look at that in a number of dimensions. I mean, the first thing is, how big is the yen carry trade? I mean, our estimates, and they're as good or as bad as anybody else's, would probably say about circa 500 billion, and maybe a lot of that has already been unwound, or certainly the financial element of that. I mean, there's a case for saying that maybe those industrial corporations that hedged yen exposure may still have the trade on. But generally speaking, what you've got is a significant unwind already. Now, that by definition reduces liquidity, but it's been liquidity that has been focused in a very narrow area. So Japanese equities, clearly got thumped as that trade was closing. And what that really means, or what that signifies, is that many hedge funds were likely borrowing yen and going long the Japanese stock market. And as the yen spiked higher, stronger, what you saw was that trade unwind, and therefore the other side of the trade meant that the Nikkei tumbled as Japanese shares were sold. So I think that's probably a reasonable explanation. But I think you've got to maybe look beyond that and say, is there anything else which could be going on here, which may be important for investors to kind of think about? Now, I go back to saying that, what policymakers really want to do is to try and establish, let's say, sensible or feasible or sustainable trading ranges for their currencies. And the one thing that central banks and treasury ministries don't like is trending currencies, particularly currencies that are trending in the wrong direction. And what they prefer is stability generally. So what they're really aiming for is to cap any significant excesses in terms of breakouts of currency units. And I think that maybe is what we're seeing here. There may well have been a deliberate, and there may well have been a concerted attempt to try and pull the yen back into a more sustainable trading range against the US unit. And what I would tend to think about it is in those terms. Now, I think you can go a little bit beyond that and say, well, okay, this is maybe not just about Japan, US. It may also embrace China, and there may be some quid pro quo going on here, whereby the US has agreed to get the dollar down slightly against Asian currencies, or at least stop the appreciation of the US unit against Asian currencies in return for something else. We don't know what that something else is, but we could surmise it could be support for the treasury market or whatever it may be. But effectively, that is what investors should be looking for. Is that a negative or a positive liquidity event? I think the answer to that really depends how it unfolds. But I would point people back to what happened in 1985 with the Plaza Accord. The Plaza Accord was an attempt to actually redress a similar imbalance when the dollar was strong, when the yen and then the Deutschmark were the casualty currencies. And there was an attempt to get the dollar down and the yen and the Deutschmark up in September of 85. What that led to was a significant liquidity boom that led up to the 1987 stock market crash. Now, I'm not suggesting we're about to see an upcoming crash, but what I'm saying is you may get the first part of that, which is a lift off in liquidity. And that's what I'd be looking at. Markets, or particularly global liquidity, I should say, are very sensitive to the US dollar, and a weakening dollar will encourage global liquidity to expand.
Very good. Okay, so, this is just a couple of days, but when the VIX spikes to 65, we know events in the recent past of what happens. I mean, obviously we had the COVID flash crash or crash, whatever you want to call it, 2020, but we did have the GFC in 2008 with 65. With this VIX spiking up that high, I mean, it's very concerning because history often rhymes. So how are you watching the volatility, as it plays into this kind of liquidity form and where it's going? And it seems like we've seen a lot of selling of equities throughout the day, right? So we've seen the market opens, equities are higher, but then just slowly dissipates throughout the day. I mean, so talk about what you're seeing from as far as relation to the volatility and wherever liquidity is heading.
Well, I think you've got to look at it maybe not just on a daily basis, but over a period of maybe, let's think about the next 2 or 3 weeks. Inevitably, people are going to be spooked by what's happened. They're going to phone their brokers, phone their fund managers. They're going to liquidate some of their positions. and that will filter through. So, investment managers will be getting sell orders to try and pare down positions during this week or maybe the next week or so. So it's quite possible many people have been spooked by the volatility, that's for sure. But I think you've got to look through that and say, what are the underlying trends? Equity volatility is clearly important, but it's not the most important factor out there. What really drives markets is thinking in terms of bond market volatility, particularly treasury volatility, and also thinking of forex market volatility. So if you start to get the dollar or the yen increasing their volatility, then that's of concern. But more particularly if the treasury market itself, for example, look at the MOVE index, which is a measure of US treasury market volatility across the curve. If that spikes up significantly, then we may have a problem. It has been elevated in the last few days, but it appears to be coming back. And that's what I would be reassured by. And the reason that the MOVE is so important is that in the modern world, credit markets and particularly liquidity require collateral. The size of haircuts that credit providers give on collateral depends on the volatility, particularly of that collateral, and that collateral is often US treasuries. So if you start to see increased volatility in the treasury market, then haircuts will increase, liquidity will become impaired, and you may get a downward spiral. I don't think we're seeing that.
I'm glad you mentioned the bond market because today we have a 30-year auction that's about to take place prior to us recording. But yesterday, on Wednesday, there was a 10-year auction, and it was terrible. I've never seen so many people report on a 10-year auction just because this one was just so bad. What's the dynamics behind why this auction was so bad? Why do few people want to come in and start purchasing these things at these levels?
Well, I think Trevor, it comes back to basic supply and demand. There's an awful lot of supply coming. We know that the US deficit is blowing out. That's not just a one-off phenomenon. That's here for the long term. And basically, the Treasury is going to have to sell a lot of coupon debt over the course of the next few years. So I think investors are pretty much assured that these are not going to be bargain levels. They're going to probably wait until yields are higher before they start to bid. And we've had a big rally in the market in the last week or so, last 2 or 3 weeks. And so prices are actually quite elevated for Treasury securities. Why not wait till the next auction, because the next auction is coming. So I think it's simply supply and demand.
Okay. Anything, would that carry trade unwinding have anything to do with yesterday's terrible 10-year auction? Japanese just not coming in and purchasing all these?
I don't think necessarily. I mean, maybe there is. You could draw a narrative and say there is some connection. But I think the underlying background is that if you look at Treasury auctions over the last few weeks or months, I mean, the general tenor has been one of disappointment, growing disappointment. And I think the fact is that if you're issuing so much debt into the markets, and it's not just America that's doing this. I mean, every country is in exactly the same position. There's an awful lot of paper coming through, into markets for investors to absorb. And this is the problem. I mean, one of the points that we keep making or banging on about is that financial markets are now increasingly debt refinancing mechanisms. There's an awful lot of debt to refinance, and what you need is liquidity in this environment. The relationship over the very long term tells us that the ratio between debt and liquidity is pretty constant, or should be pretty constant in the long term. So the more debt you have, the more liquidity you've got to have to basically refinance that. So we're in a world of rising debt, but we're also in a world of rising liquidity. And that matters, as we know, for precious metals, for things like Bitcoin, and for the commodity constellation.
Yeah. So I'm glad you mentioned the debt, and I wanted to go back and quote our friend Peter Bookvar, actually, from a recent post after that 10-year auction, and just read this off. And kudos to Peter, man. He just follows all this stuff like a hawk. He wrote, maybe debts and deficits really do matter this time, and if the economy rolls over and the unemployment rate rises, the U.S. government will collect less in tax receipts, and that $2 trillion deficit becomes $3 trillion, and that 6% budget deficit of a percentage of GDP will be 10%. we're kind of getting, it seems, to a point where I don't know if this can be the end game, but you and I have talked about really the potential of a central bank coming in and being the refinancier of last resorts and being the only purchaser of U.S. debt. I remember that conversation fondly you and I had in Frankfurt last year, Michael. With these deficits, I mean, is the global market finally coming home to the realization that this is just unsustainable for the U.S. economy?
Well, I think the answer is, and maybe the sort of disappointing answer in many ways, is that it is sustainable. I mean, that's the problem. Look at Japan. I mean, Japan has got much, much bigger debt burden than America has now. Maybe prospectively America will get, but Japan still stumbles on. Governments can sell debt. They do sell debt. The question is, at what yield base do they sell that debt at? And what happens to other asset classes? And I think that what you've got here is the potential of the US government crowding out other players in the market. And so what you've got is that everyone's focus is really on treasury coupon issuance. Or if it's not treasury coupon issuance, it's increasing bill supply, treasury bill supply. Now, the issue with, the whole issue with the calendar and how debt is raised in America is what is the duration or the maturity, average maturity of debt that's been sold. And one of the points that we've made in the last couple of years is that one of the other dimensions of monetary policy, in a sense, is actually changing the average duration or maturity structure of the calendar. So in other words, rather than selling 10 or 20-year coupon debt, what the US government is doing is selling much shorter dated issues, maybe around the 5-7 year tenor. And what that basically means is that they are leaning more and more towards monetization of the deficit. Now, the reason for that is that credit providers like banks prefer to buy shorter dated government debt, bills, 2-year bonds, etc. And that is direct monetization by definition. If a credit provider buys government debt, it is printing money by definition. And that is the route we're going down. If a long-term institution buys government debt, that is just basically a use of existing savings. So it's a very important distinction to draw here. And what we're moving into is a realm, as I've made sort of or said ad nauseum, of more and more monetary inflation. Monetary inflation isn't necessarily high street inflation, but it often spills over into high street inflation. Monetary inflation tends to drive monetary inflation hedges like gold bullion and things like Bitcoin. Bitcoin is likely a monetary inflation hedge simply by evidence of what it's done in the last 5 years or so. It's kept up, or it's more than kept up, with the pace of monetary expansion. So these are the things to start looking at. Just take a look at the gold price over the last 5 years. Looks to me like an upward trend from bottom left to top right.
Yep, it certainly does. I'll agree with that one. I want to ask you about and I even forget the number now because it seems like many, many years ago, but the amount of dollars created during the COVID response, I think we got up to 4 or 5 trillion that was handed out. And that was obviously a massive liquidity event that spanned over many, many years. And I'm just kind of curious, with that stimulus, if we're now starting to see the tail end of that wear off, the consumer data is weakening, obviously. We're seeing a lot of the manufacturing data weakening, demand is weakening. Are we reaching the end of that stimulus? Has it come full bore?
Well, I think there's in as you say, I mean, that was 2.5 years ago, and that savings blip has probably been exhausted to a large extent. People have spent the money, that's for sure. But if you look at deficits, the US government deficit is slated to remain about 4 to 5% of GDP, arguably, for the next 2 to 3 decades. I mean, looking at Congressional Budget Office projections. And that's simply because of the huge transfers that are involved in terms of Medicare and Social Security. Add to that defense spending, add to that the interest bill. I mean, all these are really payments into the private sector by the state. And ultimately, it's got to be paid for. Either you recycle existing savings or you print money. There's really no choice. And with savings under pressure, and yields not wanting to be pushed up too high, it inevitably comes back to printing more and more money. And providing that that doesn't spill over into high street inflation, it's quite sustainable.
Would the act of printing more money need a catalyst and a reason to do so? I mean, that's what COVID was. The reason they had to print $5 trillion to keep the economy going was on the back of a COVID response.
Well, I suppose if you're asking, are we going to get a renewed QE?
Yeah.
The answer is we will get one inevitably, and that may come sooner rather than later. But I would assure you, it's not going to be called QE. It'll be called some other acronym. So the acronym department of the Federal Reserve will be working overtime to think up a new name. It could be called quantitative support. It could be, they could try and sweep it under the carpet and treat it as their normal operations. But at the end of the day, central banks buy government debt. That's what their balance sheets are largely consisting of. And if you look at congressional budget office projections, and they're in the public domain on the CBO website, they have a rising trend of government debt held in the Federal Reserve balance sheet. This is what's going on. What we're really debating is how fast that debt expands, and that's really a question of spending levels and commitments. I mean, the vast bulk of US government spending now is mandatory spending. Their discretionary element is relatively small within that. So this is pretty much set in stone. And what you've also got is a decision on whereabouts within that spectrum they issue debt. And as I've said, if it's towards the shorter end, the odds are that is going to be pure monetization.
Mm-hmm. How about the interest rate policy? We had last week, Jerome Powell came out and kept the Fed rates flat. And then obviously we had this high moment of volatility. And then it seemed like only seconds, people, the pundits online on TV were saying, well, they should have started cutting. And even maybe claiming for an emergency rate cut because one day the VIX spiked to 65. Same old playbook here. I mean, once volatility hits, everybody's looking for a savior to come in and save their portfolio of whatever assets it's made of. But as far as the rate cutting cycle, which appears to will begin in September, which is kind of what Jerome Powell had stated in his presser. Is it too little too late now? Should they have started cutting earlier? And do you have any clout with an emergency cut? I assume we're going to see a lot more volatility for them to come in before September and do something, drastic.
Well, I think the answer is that what really matters to the Federal Reserve and the Treasury is the integrity of the US government bond market. That's really the primary consideration. I mean, there may well be, they obviously want inflation lower, they want employment to be rising, that's for sure. But at the end of the day, what causes these emergencies are disruptions within the financial space, and it's either dislocations in the treasury market or banking problems. And that's when you'll see the federal authorities come in and do an emergency cut. And that's what they've done at those times. Are we getting that right now? I don't think so, okay? Could we get it? It's possible. One of the things that concerns us is that if you look at US bank reserves, they've been drifting lower recently. You just got to look at the H4.1, which comes out of the Federal Reserve each Thursday evening to get a guide for that. But if you look at bank reserves, they've been trending lower over recent weeks. Now that's a concern because we know that regional banks have problems in the US. They are not quite as flush with cash as the big banks. And there may well be problems, particularly if the economy slows or the real estate problems actually worsen significantly. So we've got to be alert to that. That may be a reason. The bond market, per se, the treasury market, actually has been pretty well behaved of late. And so that's not really giving an excuse. So I would be very surprised if there was an emergency rate cut, one needed anyway over the next few months. My expectation is that you will see, as Jay Powell has hinted, a September move. Now, having said all that, are rates important? I don't think so. I mean, this is just really an exercise in forward guidance to try and tell the market that the Federal Reserve is pointing in one direction or the other. What really matters is the amount of liquidity that's pushed into markets. And I think you've only got to look back over the last 5 years to actually realize that what matters much, much more than interest rates is basically the flow of liquidity into markets, what the Fed balance sheet is doing, or more generally, what credit providers are doing. These are the key things. So basic question is, what's going to happen to the Fed balance sheet over the rest of the year? Now, my expectation is that you will likely see an expansion in what we call Fed liquidity, which is the more active parts of the Fed balance sheet. It may well be that arithmetically, the headline balance sheet continues to be pared down, a la their QT policy. But the active part of the balance sheet, the liquidity creating part, is much more likely to expand. And that will be reflected in increasing bank reserves. And I fully expect that to be the case. If that is the case, asset markets are going to get a second wind upwards. And that's what we would imagine. What does it mean for the economy? Well, my view is that if you look at the business cycle, it's largely derivative from the financial sector cycle. So if you start to see an expanding financial sector, strong asset markets, you're going to get a strong economy. Clearly, fiscal policy has a role in that too. So if the federal deficit is wide, that's going to be a significant factor. What impairs the economy over the medium term, and particularly the small business sector, is the level of interest rates. So that's where that has a binding effect. And if you keep interest rates at high real levels for long enough, you will impair the long-term productivity performance of the US economy. And that is what I think is the danger. You may not affect the cycle, but you're going to affect the long-term trend.
Well, in an economy that is based on debt, and we are starting to, and consumers and consumerism, this is having effects on consumer credit, right? I mean, I saw a stat I had to pull up as you were talking. 30-day delinquency rates of credit cards is at 9.1% and autos at 8%. That's the highest since 2011. So do we have are we approaching a systemic consumer credit real problem here?
Well, I think that again, my answer is that if you keep interest rates high enough for long enough, you will start to get these impacts. It's not the fact that raising interest rates affects the business cycle in the way that it used to. It tends to affect the trend in the economy. And what you're seeing is the accumulated effect of high interest rates over a sustained period that is starting now to impair consumer loans, housing, car loans, housing loans, etc. And it's starting to affect adversely, I would imagine, the productivity of the small to mid-sized business sector in the US, which is critical for US productivity performance.
Yeah, okay. Michael, you've seen a number of cycles. You've seen a number of days of volatility, many things. Is there a playbook for this? Is there an algorithm or time in history that this reminds you of? I've seen, we don't quite know if this is 2008 or 2018, kind of that question right now. But, is there a moment in your, career that this starting to sniff something similar?
Well, I alluded to the Plaza Accord earlier on. The Plaza Accord occurred in September of 1985. It was a concerted attempt by then, I think, G4 policymakers to get the US dollar down. The dollar had been run away during the early 1980s under the Reagan administration and Volcker's tight monetary policy, fiscal deficits or loose fiscal policy, big fiscal deficit and a tight money policy propelled the dollar higher. We've got pretty much the same mix right now, so it's not a great surprise the dollar's strong. And by September of 85, there was a concerted effort to get the dollar down. Now, we've now got more publicity shy central bankers or policymakers. They're not going to stand on a soapbox or go to a hotel in New York to actually announce these things. It's going to be much more secretive. But I would imagine that they're probably thinking along these lines. The dollar can't keep going up. The dollar is already, a high dollar is already imparting pain throughout the rest of the world. And the yen in particular has been in the sights given the fact the yen has been in freefall. So this is a sort of period, particularly the summer period, where policymakers will often act to try and change underlying trends in currencies. And I would imagine what is going on, if there is something going on, is they want to move the trading range for dollar yen down to something which they perceive to be more sustainable. And if they do that, they will take pressure off the Chinese yuan. Now, we haven't mentioned China because China is, as we know, the elephant in the room, but it's also something to think about very carefully because Chinese monetary tightness, particularly over the last few months, But then equally over the last few years since the COVID crisis, has been a major factor which has actually taken a lot of the steam out of the world economy and caused commodity prices to be lower than they otherwise would be. If the Chinese economy starts to pick up again, what you're likely to see is a surge in economic activity globally, and you'll see much, much higher commodity prices. Now, the precondition for China to ease, as far as we can see, is number one, a weak economy, where you can tick that box. And number two is Chinese yuan, which is at least stable. And if the dollar starts to come down and pressure is off the yen, then you will likely also see, in my view, some stability coming through into the Chinese yuan. And lo and behold, what we've seen in the last few days is evidence that the Chinese yuan can strengthen. And I believe right now it's trading pretty close to its highest levels for the year. So that will give a window for the Chinese authorities to do something.
What would that Chinese stimulus look like? I mean, do you think they go back to the old playbook with infrastructure spend? I mean, they built so much, 15, 20 years ago that it's unoccupied. I mean, what would be that stimulus? Would they try something different?
Well, I think you've really got a very narrow range of choices because we're talking of China here. They're not going to stimulate the consumer because that's not really their political model. It's very difficult for them to do that anyway. They don't want to economically enfranchise the consumer in the way that America or Europe does. So that is probably out. Infrastructure is an obvious choice. The Chinese are particularly efficient at that. So it may well be more infrastructure. It may well be more exports. But ultimately, the Chinese economy has to grow. Am I saying that China does not have a structural problem? No, I'm not. China has deep structural problems. It's basically, it's rather like, let's say, a small Asian tiger on steroids. I mean, it's basically, it's a big, big economy. It's overproducing. It's dumping a lot of its goods internationally, and maybe a little bit akin to the old Soviet Union. It's not market driven. So planners are making these decisions, and they're just saying, keep on going, keep on producing. The trouble is that those goods have to be dumped into the world economy, and that's the problem we all face. So we've got this deflation or disinflationary problem continually emerging out of China. Now, China faces, as a result of that, a very significant price deflation and very significant asset deflation. And the only way that China can avoid those problems is basically a monetary inflation. It's not a happy recipe or remedy, but that's all that I can envision they do. They've got to print money to try and dig themselves out of this hole. But the Chinese economy is basically unstable, and the current model is unsustainable. The problem is, rather like the case I made with Japan earlier on and Japan's high debt levels, this thing can go on for decades before it derails.
Mm-hmm.
But money printing is coming. It's got to come.
And you're kind of thrown out of play. Like, it's a global money printing and every major currency.
Well, I think the only way that we resolve this problem is you've got to get monetary inflation up higher, simply because we've got this whopping great debt load. That debt burden is unsustainable. This is why we're in a new world, because there is so much debt. Now, if you go back and people draw the parallel with the 1950s or late 1940s or whatever it may be, or the 1970s, this is different from those periods because the debt GDP ratio today is significantly higher. And the problem is that debt compounds. So if you've got an interest rate, a real interest rate as high as we've got today, the cost of servicing that debt is high. And the problem is that interest payments are added to the debt. And so what you get is an exponential growth in the debt GDP ratios. Now, the only way you can really get out of that is either to renege on commitments, mandatory spending commitments. So you say to people, okay, we're not going to have Medicare, you can't have Social Security anymore. We're going to pare down those spending commitments. Or what you do is you get your GDP growth up. Now, we know, and the evidence is there in the last few years, is that productivity growth is slipping as well as demographics age. So it's extremely difficult to achieve that. It may well be that we're looking at an AI miracle and the AI bails the world economy out. But hey, that's another big step as far as I'm concerned.
Well, that seems to be the only hope. It's the last hope, right? And obviously, it doesn't seem like this is going to happen tomorrow, this end of this year or next year. I mean, there's a lot to be had here, and still early days with AI, but I just don't. I'm not quite sure. If you talk about other periods of history of economic growth, it was you mentioned the word compounding interest. I mean, all these things compound. It's not something that just hits the market and then the next day all of a sudden you've got booming productivity. It's this natural evolution of finding a new tool that potentially has the opportunity to increase productivity, but how do you harness it and how do you leverage it in many, many different ways? I mean, I think we kind of use AI as just like this blanket term, like, oh, it's going to make our lives easier. It's like, great. Generative AI, it's like, sure, it makes, like, I can generate a PowerPoint presentation pretty dang quickly. It will save me hours during my day of doing that, but does it really improve economic productivity? Does my like creating a funny little social media video using AI really increase economic productivity? I just don't think we're there yet.
Yeah, I'm sure you're right. I mean, I will come quietly and agree with you because I think that that's the reality. But actually, before we actually opine on the value of AI or not, there's got to be a lot of real investment to actually get there, and that real investment will entail more commodities of some description. And so you're
Right.
going to get some form of economic boom if all these major players in the technology space engage in the sort of investment programs that they're slated to do.
Well, and I think I saw a stat with all the AI data centers that are being built by the major tech companies. And I think, and I hope I get this right. I think it's pretty close, but Google itself is going to have to generate $50 billion in revenue to just break even on this infrastructure. I mean, so they are going really deep, and I get this. You need to think, many decades down the road here for major companies. I totally get that, but holy cow, it almost seems like it's that spend is putting the cart before the horse a little bit. But that's just a lot to ask. That's a lot. I think it seems like an overspend at this point.
Right.
Maybe I'm wrong. I don't know. That wasn't a
Well,
question. I think that was just a
well,
statement.
well,
But Mike, going from here, we are in a seasonal period of the year of heightened volatility. Boy, I tell you what, the end of July hit, August came in like a wrecking ball. As we kind of walk through the rest of this month and into September, maybe October, I mean, there's a number of things you're like really paying attention to here that maybe listeners would want to maybe keep on their screens or make sure they're keeping the finger on the pulse of.
I think the key things, as far as I can see, are number one, the election. Number two, China. I mean, these are factors which I think are absolutely critical. And the election, depending on who gets it, will clearly dictate to some large measure US policy over the next 4 years. And then China is likely to make, we think, a significant policy shift towards monetary easing at some stage. So these are two critical factors to watch. Now, my reading of those eventualities, since they probably both involve some weakness in the US dollar, is likely to be positive for global liquidity. We still maintain that the global liquidity cycle is going up. Our original estimates made in late 2022 would suggest that cycle peaks in late 25, and that is really the driver of financial markets. We see no reason to change that view. And on top of that, you've got a rising trend in liquidity from this underlying deterioration in fiscal finances worldwide because governments have to print money.
Okay. Mike, it's always a pleasure to spend some time with you. Incredible insight. What a week. I don't know. It caught me by surprise. Were you at all surprised with that spike in volatility? Did you kind of
Well, I
see it
think
coming
that
at all?
one's always surprised by big spikes for sure. But I think by definition. But at the end of the day, we're in a seasonally illiquid time in markets. We had a couple of events which warranted some scare, if you like. Maybe there was an overreaction. I mean, seeing the Japanese stock market down at one stage 12, 13% during the day is a significant event by anyone's standing. But it did bounce back. And I think the reality is you've got to look through these events. I mean, maybe spend a little bit longer on vacation through August in future. But, at the end of the day, I think the trend, I mean, the key factor is, look, you've got to ask this question. Is this a change in risk positioning, or is it an underlying change in the liquidity dynamics in markets? And I would argue it's the former, a change in risk exposure. Investors have taken risk exposure down. We can judge whether that's valid or not. I think it's probably got some merit, but at the end of the day, risk markets are going to perform over the next 12, 18 months anyway, favorably, simply because the trend in liquidity, I still believe, is upwards. And nothing I've seen in the last few days changes that view. In actual fact, it may even reinforce the fact that liquidity is going up.
Very good. I actually was surprised. Gold really hung in there. It could have really fallen off a cliff here, but that day of volatility, I mean, it was down meaningfully, but it was getting bought up in the U.S. markets and well off of its bottoms. I was actually really impressed that gold's doing exactly what it wants what you want it to be doing.
Yeah, that's I think it's a very meaningful fact to quote. Gold has held up, and this is telling you there's strong underlying demand for gold. And if you look generally, as I said, take a 5-year chart of gold. Don't just look at the last 5 days or 5 weeks. Look at a 5-year chart. It's basically gone from bottom left on the chart to top right. That trend looks to be pretty well established. And what follows from rising gold is rising commodity markets.
That's right. All right, Mike, thanks so much for your time. Hopefully I see you in about a month and a half's time when I'm over in your neck of the woods. Appreciate it. Thanks so much. Have a great
look forward to it. Thanks for the time.
Bye.